Hello friends, welcome to the first video of our investor education series. This video will help you to invest smartly and to understand the various investment parameters that you should look before you invest anywhere. Now I will be releasing one video each week. So if you have not yet subscribed, do subscribe and hit the bell icon. So today's video will be about mutual funds, whether you should invest in mutual funds, if yes, how to invest in mutual funds, whether mutual fund investments are safe, whether you could lose money in mutual funds. All questions will be answered. So let's get started. Now, why mutual funds, or what is mutual funds? Now, as a small investor, it's not possible for any small investor to keep track of the markets and invest in particular shares, and at the same time also see that his money is not lost. Share prices and share markets are affected by various factors. It can be political factors, it can be economic factors. Apprehending such changes, investing smartly, diversifying portfolios is not possible for any small investor. So how can a small investor invest in the share market yet be safe from the fluctuations in the market to some extent, and also ensure that his funds are managed by professional persons, and also ensure that he gets a fair return? So to all the questions, the answer is mutual funds. So what are basically mutual funds? Mutual funds basically is an investment vehicle, that it is a pool of money which is collected from various investors. The money which is collected from those investors, it is then invested by some professional fund manager in stocks or bonds, or as in the money market instruments or various other assets. Mutual funds, they are operated by professional money managers who allocate the funds investments, and their aim is to produce capital gain or income for the funds investors. So if you look at this diagram, you can clearly understand what basically is a mutual fund and how the mutual funds work. So investors, they pool their money together. This pool of money is then utilized by the fund manager, who chooses the securities in which he wants to invest that pool of money which has been generated. Through these securities, returns which are generated, it's passed on to the investors. Now, when you look at the diagram, it's very simple process, but it's not so much simple. The fund manager is a professional. He has to choose securities and he has to invest the money into a diversified sectors of securities, so that the returns generated and that the money is not of the investors is not lost. So why to invest in mutual funds? So mutual funds, it gives small and individual investors the access to professionally managed portfolios of equity, bonds and other securities. Now, one of the major factors which affect an investment is diversification. It's very important to diversify your investment. If you keep on investing in one form or in one sector, it is more likely that you can lose your money. So mutual funds will provide small investors the benefit of diversification. Mutual funds, they generally, or most of the funds, they invest in a diversified field or diversified sectors, thereby reducing the chances of losses. So the major benefits of mutual funds can be, they are convenient form of investments. You have to just invest the money. Your fund is managed by professionally trained and professionally qualified persons. It is safe and it is transparent because it is regulated by SEBI regulations. Mutual funds in India are regulated by SEBI regulations, and they are transparent because you can actually see whenever you invest in go to invest in mutual fund. I will discuss it and I will show how you can see the sectors in which your particular fund is investing, what is its NAV, which is the net asset value. Through the net asset value, you can determine whether the fund in which you are investing is being properly managed or not. You can see the rise or fall in the NAV in the previous years. Also, you can also see the percentage of return before you are investing in any particular fund. We will discuss it in detail as we move forward. Now, it's economical, it provides high returns, there is diversification, there is liquidity. So when you move on to choose any mutual fund scheme, what are the factors that you should consider? First is that the risk that you want to take. How much risk you want to take? If you want to take the lowest of the risk, then you go for debt funds, that is the funds which invest in debt securities only. But in that case, the returns will also be low. If you want to take it's okay for you to take high risks, then you can go for equity based funds. There the returns are also high. So the higher risk you take, the higher expectations of returns. The lower risk you take, the lower expectations of returns. So in mutual funds, they can be divided on the basis of structure, investment objectives and others. On structure, they're open-ended and closed-ended funds. On basis of investment objective, you can invest in dividend funds, you can invest in balanced funds or hybrid funds or growth funds. Dividend funds, these funds basically they provide you dividends. Growth funds, they provide you more capital appreciation. Then we have tax savings funds, we have exchange traded funds, etc. Second point which you should take into consideration is the tenor for which you want to invest. What is the time span for which you want to invest? The longer the time for which you invest, the higher the return you can get. So if you have short-term goals, you want to invest for short period of time, you can invest in liquid funds or income funds or ultra short-term funds. If you have medium-term goals, you can invest in balanced funds or MIPs. If you want to invest in long-term, then diversified equity funds or equity-linked savings scheme funds. You can invest in large or mid or small cap funds or sectoral funds. These funds will give you higher returns if you are investing for long-term goals. Third point which you should keep in your mind while you're investing is the sectors in which you want to invest. If you want capital appreciation, equity mutual funds are the best choice. Equity mutual funds will appreciate your investment value. So for capital appreciation, equity mutual funds should be your choice. If you want regular incomes, then you should invest in debt mutual funds. They are the least risk funds and will give you regular incomes, but the return is less than equity funds. But if you want balanced growth, then you should invest in hybrid mutual funds. They will give you a balanced growth. The risk is more than the debt funds but less than equity funds. Returns are less than equity funds but more than debt funds in cases of hybrid mutual funds. So in this table you can see the returns of the equity mutual funds. So if you can see the large cap mutual funds, multi caps, mid cap and small cap. Small cap mutual funds, they give the highest return but they have the highest amount of risk. Mid caps, less risky, less return. Multi cap, less riskier than small and mid caps. Returns are also less. And large cap funds, they are the least risky among the four, but the returns are also least. So the higher risk you take, the higher possibility of return, but the risk, as the risk also increases, many of the subscribers to mutual funds, they don't want to take so much risk, so they take the midway. They can invest in multi-cap or mid-cap funds. Now, how can you invest in mutual funds? You can invest either by way of a SIP, which is a systematic investment plan, in which you invest a particular amount of money every month. Now the money can be any amount. It can go as low as 500 rupees, or you can, secondly, you can invest a fixed amount. Suppose you invest 5,000 rupees into a particular fund, or 10,000 rupees, that is a fixed amount investment. Or you can go for systematic investment plan, that is investing a particular amount each month. If you are a beginner in mutual funds, I would suggest you to go for a systematic investment plan rather than a fixed amount of investment. Now the major question which arises is, how can I invest in mutual funds online? What you have to do is, first of all, you have to select the mutual fund scheme. Then you have to go to the mutual fund house's website. If you select SBI Mutual Fund, you have to go to the SBI Mutual Fund's website. Select Reliance Mutual Fund, you have to go to Reliance Mutual Fund's website. Or if you select any other mutual fund house, you have to go to that particular house website. Or secondly, you have options. You have various online investments. So first of all, you have to open an account in the mutual funds website. You have to do your KYC, link your bank account, and then a folio number will be generated. Your PAN bank account numbers will be linked to that folio number, and you can start your SIP or you can invest online. So in this chart you can see that the liquid funds, they are for short-term surpluses. They are short-term funds. We have already seen that. Now, for risk, the lowest risk is for liquid funds, medium risk is debt funds, and highest risk is the equity fund. Similarly, as the risk is low, the return is low. Here the risk is medium, return is also medium. Here the risk is high, the return is also high. Time horizon, short term. If you invest for short terms, your returns will be low. Invest for medium terms, returns will be medium. If you invest for long term, your returns will also be high. So it's not that you always look for the highest return. You have to also look at the risk, your risk profile, your financial goals, and what is the tenure for which you want to invest. On the basis of these factors, you can invest in any kind of funds. If you want to take higher risk, you go for equity funds. If you want to stay balanced, you go for debt funds or balanced funds. If you want to invest for very long term, equity funds would be your option. So how to select a mutual fund? First is that there are different types of funds, and first you have to select the mutual fund on basis of 3 golden rules. So what are the golden rules? First is expected return. How much you want to earn from the investment. If you want to earn a lot from investment, then you have to go for higher risks. You want to earn, you are not expecting very high returns, and you want to keep your risk profile also not very high, then you go for the balanced debt funds. Also, the investment time horizon. What is the time for which you want to invest? So you have to make a choice of the mutual fund investment scheme on the basis of expected return, risk profile, and investment horizon. So as I have told you, when you want to invest, if you go to a particular mutual fund website, in this case I have gone to the SBI Mutual Fund, and you choose any fund, the mutual fund companies have to compulsorily give you all the information regarding that particular fund. So I have gone to the SBI Mutual Fund website and selected the SBI Magnum Mid Cap Fund. First information that I get is about the fund manager, who is managing the fund. You can see the name of the fund manager, the date from which she is managing the fund, and the total experience is also given. You can even see all the funds which are managed by this particular fund manager. Next, you can see the category in which the fund it invests, that is equity funds. Risk is also written moderately high. It's a mid-cap fund, so the risk is moderately high. When was the fund launched? The date is given here. The benchmark in which the fund belongs to, it is the Nifty Mid-Cap 150. What is the return since its inception? 15.29% for regular growth. Minimum lump sum amount you can invest is 5,000 rupees and in multiples. Secondly, it also shows the portfolio holdings. Where has the fund invested? A diagram is even provided for you. A chart is provided in which sectors the fund has been invested. So as I have told you, the portfolio holdings, the companies in whose shares the fund is investing, the sectors in which the fund is investing. The largest sector here in case of this mid-cap fund is financial services, then pharma, then industrial manufacturing, construction. All details will be provided to you. Whichever mutual fund you choose, first what you have to do is you should visit the website, look at the fund, look at the portfolio holdings, look at the sectoral breakdown, whether you want to invest in that particular sectors. Only then you make the choice regarding the fund. The growth rate is also provided here. The growth rate of that fund, the benchmark growth rate, the current value of investments, they are all provided. Every information has to be provided to you by the mutual fund. So you have to just see whether the fund is beneficial for you or not, and then you invest. Don't just invest on the basis of any advice given to you by any person or by seeing someone else's investment. You don't go and invest in a particular scheme. You yourself should look at the scheme, look at the growth rate, look at the value of the investment of current value of standard investment 1,000 rupees. What is the current value since its inception? What the current value on all see. Even the risk factor is even given here. These are all the investments, top investments of SBI funds. So what are the risks? Moderately high for multi-cap, moderately high for mid-cap, blue chip funds, what is the returns, all are given here. So you yourself go to the website, check the fund and then only invest. So the two important questions comes to any investor's mind is, first question is, am I going to be cheated and lose all my money in case of mutual fund? There is a high possibility that you will not be cheated. Mutual funds, they are regulated to very high standards by SEBI. They are run by professional managers. They invest in those companies only which are listed on major stock exchanges, which are also regulated by SEBI. Investments, they stay in your name at all the time, and all money transfers back through are made through the official banking channels. So the chance of you falling to victims of fraud is nearly zero. It is definitely very, very much more secure than chit funds and other shady investment schemes which are offered to you. But you have to remain vigilant while you're investing. Invest directly to a fund. Don't go through other channels. Then there is a high chance that you will not be cheated. Second question that comes to any investor's mind is, can you lose some of your money? There are chances you can lose some of your money, because mutual funds, they make investments in market linked assets. Markets, they keep fluctuating, but since mutual funds, they are diversifying their investments into various sectors, various shares and securities, the chances of losing money is can be restricted to a very lower extent, but there are chances you can lose some of your money. So definitely look at the risk which you are willing to take, and on the basis of the risk which you are willing to take, you can invest in the security. Mutual funds invest in various securities, shares, bonds, debt securities, government securities. If you don't want to take any risk and you also do not want very high returns, you can invest in the mutual funds which invest in government security. There are mutual funds which invest in government securities. So look at the investment portfolio of your fund, invest wisely, and then you will not lose your money. Thank you for watching this video, and we'll soon be bringing on investment related videos for beginners who want to start investing, where you can invest, what are the best options which are available for you. So stay tuned and do subscribe to the channel and hit the bell icon. Thank you. Bye bye.